RioCan is without a doubt one of the most popular options right here in Canada if you're looking for REITs. And with the news that they recently slashed their dividend by 33%, I figure now would be a great time to do a little overview of the company and assess whether this is a good stock to buy, if it's undervalued, if it's a stock that we should be selling if you're a current shareholder, or if it's one that we can kind of just sit back on. But that's exactly what we'll cover in today's video. I hope you guys enjoy. What's up, you guys, and welcome back to the channel. If it is your first time here, my name is Brandon. As always, we do offer courses and training through our Investing Academy, which is that first link down in the description below. But let's dive on in, starting with this overview of RioCan. I know a lot of the viewers are quite familiar with this company, but for anybody that isn't, the ticker that we'd be looking at here today is REI.UN, a very standard ticker format for a trust or for a REIT. Today's shares are trading at $17.41 Canadian with the $5.5 billion market cap. And of course, we see a pretty substantial sell-off, pretty substantial. Shares have dropped about 30-40%, and the yield obviously that we're looking at there is not yet reflective of this 33% drop. Just as a little bit of background in terms of how the stock has done historically, it's been a great stock to own. It's been a clear outperformer versus the TSX, which is this darker line. This is the benchmark of the Toronto Stock Exchange. Down at the very bottom, even amongst the REIT index, so the Real Estate Investment Trust Index in Canada, represented by gray, RioCan has been a stronger performer. Note as well, though, it has sold off more significantly. So let's call it higher swings, higher highs and lower lows. And I will mention very briefly, because I think this is very important, if you are not entirely familiar with what a REIT is, I mean, I'm sure we all know that they involve real estate investment trust is what they stand for. A very brief background on that. I always like to envision a REIT like a basket, and very similar to an ETF or any fund for that matter, where within a specific basket, they can own a number of stocks. Typically, normally a ETF would be comprised of the Teslas and the Microsofts and all sorts of companies. A REIT is exactly that, but instead of owning stocks, it's a portfolio of real estate. And it's often a combination of retail buildings, so commercial real estate like office spaces, shopping malls, you name it. Very, very popular part of commercial REITs, as well as residential units. So apartment buildings, rental units, there's all sorts of family homes, there's all sorts of combinations you can have. But if we take a look into RioCan in particular, you'll note that they are predominantly a company involved in the retail side of things. So very heavily weighted to retail and office spaces with a lot of room to grow in their residential area. This is actually, just FYI, the second largest REIT in Canada. Just to get some perspective, if we looked into the REIT ETF, which basically comprises of a bunch of Canadian REITs, you do note highlighted in here red, it is the second largest in terms of market value, only behind that of Canadian Apartment Properties REIT, or Real Estate Investment Trust. In terms of where they do business across the country, predominantly we can see in this bubble that Toronto, the Greater Toronto Area, represents about 51% of revenues, which, as we'll touch on in a second, is one of the very heavily impacted areas in Canada with COVID. But you do see business expanding across 6 major markets at a smaller rate. But before we dive on into what I believe to be a very interesting chart and a very interesting thing that we can take away from this video, I'll pose the question: how many of you guys are currently holding RioCan? I know for a fact that, especially on YouTube and especially on the internet, this is one of the most popular REITs. I think rightfully so. It's a great option here in Canada. And I know for a fact we're going to have a lot of holders of this REIT. So out of curiosity, leave a comment down below. But I'll pop up on the screen here. This will kind of start in getting us into the video. This is a breakdown. It's just another way of showing, obviously, their geographical area at the top, 50%. But we're going to be focusing in on this bottom area and try to make sense of why we saw this dividend cut and if it's something to be concerned about. Because the bottom half of this chart, graph, or whatever you want to call this, a chart, represents the top 10 sources of revenue by property tenants. And this is, of course, tenants that lease out or rent some of their commercial building space. You will recognize all of these names on here for the most part. Canadian Tire Corporation, Loblaws and Shoppers Drug Mart, the TJX companies, Cineplex, Metro, Walmart, etc., etc. But what you'll notice about this list is I've gone ahead and put either a little tick mark, which represents a tenant that is in a better position, let's call it a safer position, or just more reliable of being able to continue their operations during this crazy time we're going through, and a X mark or a little X by companies that I think are at a higher risk. And they're actually highly dependent on the economy reopening and things getting back to normal. Let's go through the list right now and actually just look at a couple. Canadian Tire, I think, is fine. And these are, by the way, these are just my opinions. You don't have to agree with them. You can, in fact, disagree. But I think Canadian Tire, although it's not an essential service like Loblaws, it's one that still has done well through the pandemic as people want to go out and buy their stuff, etc., etc. We'll go down to number 3, which is our first one, and this is TJX companies with the X. And this is the company that owns TJ Maxx. They're a retailer, very dependent on people coming in through the doors and buying their clothes. This company represents about 4.8% of annualized rental revenue. And to me, this is one of those at a higher risk category, which is hence why it has the X. Cineplex is an obvious one that is very much struggling, losing millions and billions of dollars currently, and really just waiting for this economy to get back to normal. This represents about 3.8%. You go down the list, Metro, Walmart, again, these are essential services. Montana's Harvey's Swiss Chalet. You could make an argument for this one that it could go either way, but restaurants are definitely not as, I think that they are still far less populated than they should be. Definitely a tricky one there. And then we see down at the very bottom, I have Good Life Fitness, which is obviously the gym tenant. That is a no-brainer that in the current state of our world, they are very much struggling to continue out their operations. And what that totals, if you look at the 4 companies that I've personally assumed or assessed here are at a higher risk, out of the top 10, that is 11.8% of annualized rental revenue that is, let's call it, higher risk. It's not to say that these companies are just going to obviously stop paying their rent and they're all going to go bankrupt. That's not the point I'm trying to get across. But if you're looking at it from the perspective of RioCan, these are some of their big customers who are really, really struggling at the moment. And you can see why shares have dropped. They're still high. They're still off about 36% off highs. And again, they've recently announced that cut to the distribution. So that was overall. I just wanted to start off with that chart because this is kind of getting you into my train of thought. These are some of the things I'm kind of assessing and thinking about when it comes to looking at a stock like RioCan. And most importantly, wondering whether we expect this to be the case going forward. But let's start off with the pros before we get into the cons. And a positive about RioCan is that we could make the argument that if we look at just the share price even, this is not the first time they've seen a significant sell-off. This was a company being in the real estate space that was very heavily impacted by the housing crisis, the financial crisis back in 2008. And what followed that, signs of a healthy and strong REIT or strong company, was a very nice recovery. In fact, I'd consider this a very quick, easy recovery. It actually reached new all-time highs in just a matter of years. So track record wise, I mean, that's something that we do like to see. They're able to kind of get back to where they were. To supplement that, another positive with the company is that the CEO, Chief Executive Officer, just purchased an additional $500,000 worth of shares. Now, $500,000 is, to an executive, it's not a massive amount of money by any means, but when we see this type of support or when we see this type of confidence coming from a CEO, somebody right in the midst of the battlefield, they know the company often better than anybody else. This is, of course, a positive sign. We could make the argument that with the vaccine rollout, we just had news in the past week that Canada is going forward with the approval with the Pfizer vaccine. This could show some promising signs that we are headed for a reopening and getting things back to normal, if you do want to look at it that way, optimistically. And then even a pro that I would consider, and if you wanted to spin it this way, is that even despite the 33% cut to the dividend, or the distribution, I should say, just as a fact, FYI, if you're dealing with REITs, they're actually called distributions, just a technicality. And you will often hear me say shares, but you're technically a unit holder. You're technically buying units or fractions of this basket so that I was talking about, but I'll just call them either way. But even despite the 33% cut to the dividend, you're still pulling in a fairly decent yield. Actually, the numbers after the dividend cut, it went from a 12-cent monthly dividend down to an 8-cent monthly dividend. They do pay dividends monthly, which again, some people may view as a positive. This is the equivalent of 96 cents per year. If you took the current share price of $17.44, if you divided the annual dividend, so 96 cents by the share price, you're getting a current yield of about 5.5%, which in the big scheme of things, a lot of people would argue that's a phenomenal yield. In terms of REITs, that is typically lower. You can often see them up at 8, 9, 10% as it was prior to this. But nevertheless, you could still say, hey, a 5.5% yield, I'm happy with that. In fact, if you are a long-term believer in this company, this may be a smart move for the company because by cutting that dividend down, they're saving about $152 million annually in cash flow. And it's kind of almost like, is that a preventative measure? As we talked about with some of those tenants, if they do have to pull out or back out or they're not able to get new tenants, does that kind of wash out some of that lost revenue? These are all some positives that you could spin for the company. Now, in terms of cons, we could spin it the opposite way and just throw the reverse back on you and say, obviously, that con number one is that the company cut their dividend by 33%. And this is especially crappy for current shareholders. If you are a current shareholder of RioCan, not only have you seen a 30-40% drop to your position, you're also getting your dividend cut by 33%. This, by the way, takes effect in February of the new year. So for the next month, you're going to be fine. But end of the day, a 33% dividend cut is very likely looked at as a negative, especially if you're an investor strictly investing in this stock for passive income. You could also flip the vaccine news and the COVID situation on a negative. You could look at it with a pessimistic view and argue that even though we are seeing approvals in these vaccines, you are starting to hear things of side effects. There's a post I saw in UK, if you have allergies, heavy allergies, they're advised not to take them. I believe there was some stuff regarding insulin as well. And even the side effects aside, there's a camp of people out there that even when the vaccines come out, they're not going to be the first ones to go out and take it. They'll let that sit. They'll let that stuff ride. They'll let that stuff ride and kind of implement out before even considering taking the vaccine. So does that stunt the implementation of the vaccine? More or less, a question that you need to be asking yourself is how long you realistically see this pandemic lasting. I mean, I'd love to say that at some point in 2021, hopefully before, half the year goes through, we can go back to the gyms, we can start playing basketball, we can do everything that we used to be able to do. But is that realistic? I mean, feel free to let me know your comments, your opinions down in the comments below. But obviously, real estate is one of the most heavily impacted areas by this whole pandemic with the shutdown of everything. So that does not bode well for a company like RioCan. Think about all of the buildings and all the square footage that they own where they're trying to find tenants, they're trying to find leasers, renters, and they're struggling to get people to even fill their office spaces. Another good one, exactly speaking on that, is that people now are working from home. Companies are realizing that, wow, we pay for this big office space and our business is functioning fine with the work from home orders. Our company is going to be rushing back to get their employees back into the office. I personally think the answer is no. I wouldn't expect that they ever cancel out the idea of offices because I think that's very important for a corporate culture. I think we can all agree on that. But it's a very big realization that working from home is kind of getting the job done, at least for now, and that may be the case going forward. So there's a lot of negatives that you could spin on this. You could even ask the question: are more dividend cuts coming? I saw a post, or I actually saw a thread, and someone was talking about the Well Center, or the Well, which is one of their big units. One of their big units in Toronto, I should say. And it's very tough to project out and make these assumptions or make these guesses in terms of how fast things will be getting back to normal. Even if, right, like I said, companies are right now, as a lot of them are struggling, they're taking on big debt loads to help weather the storm. And that stuff doesn't just erase overnight, right? Even when the pandemic gets back to normal, companies still have this burden on them for numbers of years going forward. So it's not as easy as just saying this company is undervalued, let's buy it. There could absolutely be some more cuts in store. And if the stock did cut their dividend again, or the REIT, I should say, you'd almost certainly expect the share price to fall even farther than it has today. So a lot of things to consider. And I think that this will segue into just my personal opinion. I've kind of been just speaking out loud almost and putting all my thoughts out there, but my personal opinion on whether I like the stock, whether it's one to buy or whether it's one that I will personally be buying. If things continue to get worse with RioCan and the stock continues to crumble and deteriorate, I think what that would almost indicate is that there's a bigger issue with our entire economy. Again, this company being a real estate play, their tenants are a great representation of how the broader economy is doing. And if RioCan continues to struggle, again, that's almost like me looking at it, well, all the businesses, all their tenants are continuing to struggle. And that may be more of an economic-wide slowdown, a crumble or recession. In that case, I think a lot of companies would do poorly if we did fall into another steep recession. Do I expect that to happen? The answer is no. I don't expect that to happen. In fact, I pray and hope that things get back to normal sooner than later. But it is actually a very strong reality that I think a lot of people tend to overlook. This is without a doubt a premier option for real estate investments here in Canada. In fact, I'd go as far as saying of the options available, this would very likely be my favorite. If I was going to dive into the real estate space, or if you were somebody seeking yield, income, trying to get exposure to the market, the real estate market, I love RioCan as a company. I would just say to keep in mind that it does come with its risks at the moment. So where do I feel this, or who do I feel this would be a great stock for? I think that this would be a great stock for somebody who has truly a long-term time frame. I wouldn't necessarily expect this stock to bounce back right away because, again, there are maybe some long-lasting impacts here. And if you're expecting the capital appreciation really fast, I would more or less put that on the back burner for now. This would be a great stock for somebody that would accept the 5.5% yields with the expectation that that very likely could get cut again. If you're an investor that is strictly seeking yield, if that's something you're relying on and living off of, at this point, given all the things that I've talked about, all of the risks, all of the uncertainties as to how this pandemic is going to continue to play out, I would consider this not a safe dividend at the moment. That doesn't mean that it's not a great stock to buy. If you have that time frame, it could be a perfect chance to pick up some discounted shares, some undervalued shares, but you do have to have that long time frame because I have no question that at some point down the road, they will be able to pick things back up as a company and bump their dividend back up to how it was previously. But overall, to summarize, my thoughts are a little bit jumbled here, but to summarize, I do think that this is likely a good stock to be looking at the moment. Again, it's not a stock for me personally. As you guys know, I'm not a major investor in REITs. Everyone tends to think that REITs, before this little sell-off here with RioCan, everyone says REITs they're the glory stock. You get great yields. They only go up. They've been performing well, and they have been performing well. But this is just a good reality check. It's a good reminder that even REITs can have their poor days. All sorts of equities, all sorts of investments can, and it's a good thing to prepare for. But at the end of the day, looking at a share price like this, I do personally like RioCan. Again, someone like myself with a long-term time horizon, I'd be very happy to accept the 5.5% yield for now and let the stock recover over time. And of course, it's always a promising sign when you see the CEO going in and buying additional shares of the company. If there's one thing that I like seeing about a stock that I'm watching, it's when the company CEO or the executive team goes in and buys more shares at a deep discounted price. It does kind of give us a lot of insight into what they're thinking. So those are my overall thoughts on the REIT RioCan. I'd love to hear your opinions down below, whether you agree, whether you disagree, whether you're going to be buying the stock. Of course, as I mentioned throughout the video, this is just my opinion, and you always need to do your own research, always do your own due diligence. Is it a stock that I'll buy for myself? I don't know. It could very well be my first REIT in my portfolio, but at this given point, there's likely some better options. There's likely some options that I'd rather prefer for my personal scenario and for my personal investment strategy. If you guys enjoyed today's video, don't forget to drop a big thumbs up because that really does help out the channel. If you are new here, subscribe for more content and hit the bell for notifications so you know when I post a video, because we post videos like this every week. And then last but not least, as always, we do have our Investing Academy. If you are a beginner to the stock market, if you're looking for courses and training, if you want to learn the whole DIY side of things, in particular, a very popular one is moving your money away from mutual funds, moving your money away from these high fees or whatnot. We got a program that will take you step by step through the entire process, and you get to be part of our community. But that is that first link in the description below. As always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.